Okay, good morning. This is John Locke. Welcome to the Locke and Your Success weekly trade and market update for January 13th, 2014. Before we get going, I'd like to remind you that the presentation is for educational purposes only. Neither myself or Locke and Your Success are broker-dealers, and we're not making specific trade recommendations. Any trades and the results covered in the presentation may or may not be live trades. In the event something is computer simulated, we do the best as we possibly can to make sure it is accurately represented. And also the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. If you're watching this on YouTube, come on over and check out our programs. With the M3, the Bearish Butterfly and ROCK, we have group coaching and the new Trading Triangle coaching program. Join our mailing list and you can get access to the free report, 7 Secrets to Becoming a Successful Trader, as well as sign up for this weekly webinar. And stay tuned for our upcoming programs. M21 should be out in March. I do have a solid recording date, so that is awesome. And of course the rest of these will be coming shortly afterwards. Okay, so let's quickly take a look at the markets. We were saying last week that I was bearish and at the same time thinking that the market may kind of hang up and run sideways for a while. The reason I said that, it's been doing that all year. It's been coming up to a point, hanging for a while, and then dropping out. And as of right now, my opinion remains completely unchanged. We got our sideways moves, and we've been in this really tight sideways range in most of the indices. And that usually only lasts maybe 10 to 15, maybe sometimes 20 days on the outside as far as trading days goes, and then we usually drop out. So we'll see when that actually happens, or if it actually happens, but that's what I would be expecting. So the SPX, I would expect it to be down into this 50-day moving average probably in the next week, next 5 to 10 trading days. So that's what we're thinking for the SPX. Coming over to the Dow. The Dow was slightly down for the week, but it's still in a sideways range like pretty much everything else. And I am expecting this to continue downwards towards the bottom of our trend channel. The NDX, same thing, slightly up for the week, but still in a sideways range. And I'm still expecting this to come down over the next week or so. And as for the Russell, which is what a lot of us trade, we've been in a very, very tight sideways range for the last 12 days. So this is due to break out one way or the other. I'm still thinking it's coming down, and we're going to see the bottom side of this trend line fairly shortly. If I'm wrong, or what would change my opinion on that, it would be if I saw all the indices crack to higher highs, not just the Russell. Because one of the things that the Russell tends to do is it tends to fake out a lot. Like you get this move here that breaks down and comes back up. It tends to overshoot its boundaries, and usually before I'm convinced the Russell's going to continue up, I'd like to see something else, either the NASDAQ or the SPX or something follow along with it. And until I see that, I'd be still thinking we're coming down. If we do get 3 or 4 of the indices that crack new highs, then I would say my next target for the Russell would be between 1190 and 1200. But I'm still thinking we're coming down. All right. So let's take a look at what we have for positions here. And I'm going to go to the January M3 trade first. This was what the position looked like on Monday. We were running about minus 28 delta. We were up about $2,800. If we looked at our charts, we were pretty much in the center of the position, looking really nice here. And on Tuesday, we got a fairly significant up move. So if I just run to Tuesday morning, let's see, about 11 o'clock, we are up a good 12 points here. Now, knowing that the market has been running up into expiration, the Russell's been tending for the 2 weeks to expiration, has been having some pretty good up moves, I decided just to close this out. We're up about almost 6%. And I just didn't want to fight this into expiration. I think I could have done a lot better with this because I still think the market's coming down. But I have other positions on, and they're fairly busy. And like I said, I didn't want to manage too many positions into expiration. So I just decided to close this out. So this ended up being closed out about 2 o'clock, and let's see, it came out, if I run to, well, I'm just going to go to Wednesday and just look at the reports. Let me show you the T-log. We closed it out right around 2 o'clock, and it came out to about 29.15, which is about 6% or so. Not a stellar performance, but a decent return for the month, and we didn't have to work that hard this month. It wasn't too bad. So that was the M3 trade for January. Of course, the Bearish Butterfly trade for January was already closed out for around 12% or so. If we take a look at our next trade, which is the January V Condor, that got one minor adjustment this week, and it's just mainly moving the straddle, or actually moving the call. I didn't bother moving the put. So if we come to Friday, this didn't happen until Friday let's just go about 3 o'clock here. This is what our position looked like on Friday. We still had our short strikes at 1200. We still had our call at 1140, the same as we had last week, and our other short strikes at 1020. And the position looked basically like this. Let me just back this off. And we're up in the V. And of course, my concern, I'm bearish on the market. I think the market's coming down, and I'd rather not lose. I mean, I don't have a whole lot of risk here. I mean, the worst thing that's going to happen is we run down and make $3,000, but we are up significantly more than that. So rather than risk that from happening, I just rolled my call up. So I just took this 1140 call, I rolled it up to 1170. It did cost me a little bit in time value, but it's going to be offset by the delta risk that I have, because when the market comes down, I don't want to lose all the intrinsic value in this call. So that's what I did there. I did not bother rolling the put back, because at the time, which is a half an hour later, this put was only worth maybe 30 cents. So I just left it where it was. It wasn't really worth the execution of rolling it. I could have just sold it, but I just decided to leave it. So if we come another half an hour, you can see this 1140 call was run up to 1170. If we look, and I did not change the put side. If we look now, I've locked in a profit here of approximately $5,000 if the market backs off. And if the market continues up and it kind of creeps on me, in other words, the market for me to really give me trouble, it'd have to be over 1190 in the next few days. It's possible, but I doubt it. And really, if it creeps a little bit slower, I might make a little bit more of the upside. So it's kind of worth having that call on there. But as of right now, that is the V Condor for January. The ROCK trade, which is kind of getting kicked around a little bit, which does tend to happen on, I think, Monday. Let me just go back to Monday morning. This is what the position looked like. We had 10 1130 put butterflies. We had 10 1170 call butterflies and one 1190 call butterfly. The market pulled back on Monday. You can see it's coming down. We don't usually allow a whole lot of positive delta with this. So by the time midday came around, we were well up over our maximum limits. So I ended up just selling off this 1190 and went into this position here, which is just two sets of butterflies that are 40 points apart. And this is what the position looked like here. That held me fine until Thursday, actually until Friday, but we'll go to Thursday afternoon just to show you what we looked like on Thursday afternoon, because we stayed in a fairly nice tight sideways range, right? We're up about $6,800 now. We are pushing our maximum delta number, but we haven't really exceeded it. Again, I'm a little bit bearish, so I wasn't too concerned of too big of an up move. This is what we look like here. It looks very, very healthy. And on Friday, when the market did start to push up, if we look at our T-log, I started around 11 o'clock. I added in two of those 1190 call butterflies back. Then, a little bit later on, we added another one of those right towards the end of the day at 1190 just to bring our delta down. So if we go to the end of the day, on Friday, you'll see the adjustments in there. So now we have 3 butterflies up here at 1190. Our delta is, it's pushing the high side a little bit even with that extra butterfly in there, but it's below the minimums. If I put a 4th one in here, it would have brought me down to like 130. I usually like to be around minus 180 on a position this size, so I had the choice of 130 or 213, and I'm a little bit bearish, so I chose 213. And this is what the position looks like here. Obviously, if we creep up this week, we'll probably be okay. The harsh up move is going to hurt a little bit. If we creep down, as long as the moves aren't too harsh, and this promises to be a fairly decent trade this month. And that is the ROCK trade. We're up about 71.61 now. I do commonly trade this one into expiration, so as opposed to the M3, which I don't always trade into expiration, although we've had to lately because of the way the market's been. So that is all of the January positions, I believe. So let's just hop over to February, and let's see. February V Condor is going to be here. This position has had no adjustments whatsoever. We're still here with our shorts at 1220 and 1540. Our straddle is still centered. If we look at our analyzed graph, position is looking pretty much perfect. If we get the expected pullback, then we'll end up in the bottom here. I'll probably widen out. If we get a severe pullback, we'll leave this alone. So I am expecting a pullback probably to at least 1120, maybe even 1100. So I'll probably be likely to leave this alone unless for some reason we come down in here and stall a little bit. But that is the V Condor for February. If we take a look at, let's see what else we got. Bearish Butterfly for February. This, I love the positioning of this right now. Being slightly bearish, I have butterflies at 1130 and 1160. There were no, I'm sorry, 1130 and 1150. There were no adjustments. We're running about minus 306 delta, 226 on the theta, so our delta theta ratio is getting a little high. Our gain is not very much. We're pretty much break even. But look at the positioning here. I really, really like it. If we do get our expected, what I'm expecting to happen for us to pull back into this range here, this will be a it should be a very nice trade for the month. So this is looking quite well. And we have our February M3, which got, okay, we didn't, which was entered. Tuesday, midday, we exited the January, and like I said, I wanted to put the money into February. So here we are with this position. I entered it as, if you want, let's go back to Tuesday quickly. At the end of the day on Tuesday, I entered this slightly negative delta, a little bit more negative sometimes than we have been, because a lot of the times this year we've been thinking the market's been going up. I think the market's coming down. I went a little bit more negative delta than I have been lately. I put the butterfly level a little bit further down. So we're at 1157. Normally we're 20 to 30 points. I went almost 40. Again, because I think we're coming down. And I added a call up here at 1120. So this is similar to an 1170, 1120, I'm sorry, 1070, 1120, 1170 butterfly with 1120, 1130 call verticals for this identical position. Only I just entered it as a broken wing condor order and added that call. Here is what we look like. Instead of protecting myself for the normal 20-point down move, because I think we are coming down, I'm pretty much okay for 30 points here. So that's what I was trying to accomplish. I have plenty of time if the market starts to come down to react to this. I wasn't putting myself in any trouble. And of course, if the market decides it wants to take off, this isn't a problem either. All it does is it just blows up into here somewhere, and then we just move it. So I'm really liking this position as well. I'm very, very happy with the Fed positions. And that, I believe, is everything. So are there any questions? Okay, let's see. Okay, so Ray, is the targeted mentoring only one-on-one, or can it be used one-on-few trading partners? I'm not sure I understand the question, Ray. You're just asking me if we can maybe set up a group with multiple people that, okay, yeah, so, I mean, if you want to email me, we could probably work something out if you have specific people. I mean, it would probably be a little bit more than one-on-one mentoring, but, and it's going to be a lot more effective probably than a whole group, because you can do that. Okay, that sounds great. Okay, is there anything else? All right, Steve. Yeah. So if we're running in cat position, when's the best time to raise or situation to raise the middle roof? Well, the best situation or time to do it is towards expiration, when the market's just kind of sitting in the middle. If you do it, if you raise, for those of you who don't know what that might mean, if we go into just a new account, if you're in a cat position, and let's just do a January for the heck of it here. Let's see, 30 points over. So let's just say we've been in this position for a while. Because if we were going to enter this position, we probably wouldn't buy our longs way out at 1240. It doesn't make economical sense to do it. But, all right, so if I was going to be in cat position, I'd be in something like this. Now, presumably, we'd be in this position. Usually we're up money. Sometimes you're down money, or sometimes you're even break even. Because you went into this position because the market got a little bit volatile, and we had to widen out. And in this case here, we're 7 days to expiration. We don't really have, well, actually, no, only 4 days to expiration now. We don't really have the ability to, if you want to tighten this up, it's going to be very, very tough position to manage. You're going to get whipsawed back and forth a lot. So a lot of times what we're going to do here is we're going to pull out the center. So we'll start selling off, and this is what he's talking about. We'll start selling off these. So if I convert this, I can buy 5 of these back, kind of like on a V condor when I'm getting rid of the straddle. It's pretty much the same concept. I might do something like this. And now at least I have the possibility to make money, and I'm not as exposed to market direction as if I pulled the whole center out. So in general, I'm going to want to do this when the market's just kind of flat and hanging around the center. So like this month here, we got a fairly aggressive up move for a while, and then we went flat sideways and just stayed right sideways. If you went into this position, then you'd have this issue where, geez, I can't make any money, I'm only fighting for break even, or maybe even your expiration line is underneath. So I'll gradually pull out the center of this and start taking on directional risk. I usually won't do this far from expiration, because far from expiration, this acts a lot like a regular condor, whereas if you get a decent price move one way or another, it does already draw down some. I mean, it reacts better than a condor, but similar. So you're still going to get a drawdown. But here, when I'm close to expiration, I'm not so worried about it because my theta decay is so fast, my gamma flattens right out. So even if I was to come down into here, this line raises so quickly that I can usually make up for that. If I was in cat position and I was in my February options, I wouldn't even probably consider taking out the bottoms because I have so much time left. And there's a really good chance if you're in February that the market's going to creep up one way or the other, especially if we've already been flat 15 days. So the answer to that basically is when you're closer to expiration and you're kind of in the center of your position and the market's not moving around a whole lot is when you would tend to raise that. Okay, hopefully that answers the question on that one. And oh, you're welcome, Steve. Okay, so next I just have something on capital issues. So if I am in, okay, so the question itself is, I say capital, or my planned capital, I would say, but I say the capital for the Rock and Bearish Butterfly trades are supposed to be around $50,000. But we've noticed that sometimes the Bearish Butterfly and ROCK trades exceed $50,000. And that's true if you're looking at the website trades. So one of the things with the bearish butterfly is if most months in normal conditions you can keep that under 50,000, just trading it normally, completely by the guidelines, no problem at all. Rock trade a lot of times will exceed it if you have to fully scale in. The bearish butterfly will exceed it in low volatility grinding up markets when you have to go 3/3 in, especially if you have to start adding or rolling next to expiration. But that $50,000 was meant to, is a planned capital number meant to represent the average amount that you're usually going to have in the trade. You know, that being said, you can keep the capital under 50,000 if you want to. So if I go just to our rock trade for January, this is probably over 50,000. Let's see. If I take a look at this, all right, so it's not yet. So let's say, actually no, let me go to Friday. I think it is as of Friday. So let's say I come in here and I'm looking at this and I back this out. I'm looking at my capital level. I have a planned capital of 50 and I'm 55. If I have to come in here and I actually have to add in these, which is another 7 butterflies, right? Plus 7. I have to add these in. Then I'm looking at a capital level of almost $70,000, which is significantly exceeding our 50, right? Now the thing is, you got to remember, in any of these trades, the bearish butterfly or the rock trade or whatever, your short strikes are basically where you're going to make your money because you're selling the shorts and you're waiting for them to decay, and your long strikes are your risk control. So that being said, all I need to do in this position if I want to bring my capital under, and I'll do this if I want, say I want to get into a February position and I'm short on capital, or because I usually have enough money in my account to cover that 70,000, and I'll usually let it go to 70,000 because I'm not really concerned with the with going over that amount because I usually have that much reserve in my account. But say I didn't. If I didn't, or if I wanted to make sure I stayed in the $50,000 range, I can just simply roll these in, right? I can roll 10 of these in here. I can, instead of adding here, I can add here. Actually, I'll add 13. I'll take this one and roll these 3 back, right? And this will bring me, this happens to bring me just about right to 50,000. And I added a few too many here, but there we go, having trouble counting. So this brought me down to 50, and if I want to bring myself down more, I can even bring myself down more. So let's just widen this out a little bit. Right, and this is what my position looks like, and let me just go to one line here so it's more clear. That's what my position looks like now. Let me go back to the other way. Plus 7. And I'll show you what the position looks like there. This is what my position would look like if I did nothing. If I superimpose them, you can see there's virtually no difference between, let me just back this out just a little bit more, 750. You can see there's virtually no difference in the range the trade is expected to be in of my return, and there's virtually no difference on my Greeks. If you look at my Greek numbers, my theta is slightly lower, but not enough to worry about. And my delta, oh, actually, it's because I have trades. My delta, this is actually goofed up. I don't know why. Oh, that's why, because I added in, never mind, it's because I added in the other butterflies. If I don't add in these other butterflies, let's just clear the trades. Let's do this again. Let's just roll in our longs. So let's take a look at what we have now. This is the position as we have of today. If I take these and I roll these in, let's just do 5 of them because we're not adding. We probably don't have to do 10. And I roll this in, and I can maybe roll it all the way to here, right? And I analyze that, then I superimpose my previous. I have virtually the same graph for the area of movement I'm concerned about. And if I look at my Greeks, you can see the Greeks are virtually identical. Slightly less theta, delta is the same, gamma is very, very close. So that's how that is how I would reduce my capital. And of course, my capital's gone down from 50 something, it's almost 50 down to almost about 40. So that's how I would control my capital level, and it wouldn't damage my position. Like I said, if I have the money available and I don't have use for it somewhere else, then I'll just keep it the way it is because it's more efficient. But certainly, as we come into expiration, you can roll these in and minimally affect the position and still do pretty well. All right, so that's I think that's all I have for questions, unless there's any more. Thank you, Ray, for the comment. But yeah, that's just a demonstration of capital management, and we'll do this. You can do that with all the positions. You can do it with the M3 as well. If you're in, just an example, if you're in a January M3, you want to get to a February, you can make minimal adjustments to your January that won't affect the results a whole lot, and pop into and use that capital to pop into the February, which is pretty cool. Okay, I have multiple strategy positions in a month. It's time to adjust, but adjusting strikes overlap, interfere with a second or third strategy position. How do I deal with it using synthetics? Okay, so yeah, how I deal with it is I have everything in different accounts. I have 7 different Thinkorswim accounts, and I don't overlap them. So if you're running them in the same account, then what I do, like if I'm running an M3 and a Bearish Butterfly in an account, for example, then I am going to have the Bearish Butterfly and the M3 start on the same strikes. So if, in other words, if I'm in a 1,000, 1020, 1040 Bearish Butterfly, I'll start my M3 at 1,000. Or assuming I start them at the same time, or maybe if the market's gone up and I'm fully scaled in and I have to start an M3, I'm going to start it at the same strike level as a Bearish Butterfly. It's going to help me stop from canceling out strikes and getting the position too messy, my overall position. And then, yeah, when I do verticals, to avoid getting messy, I'll do verticals on the call side to avoid goofing up my Bearish Butterfly, so I can keep my position a little clean. It does that so that it makes sense to me. I think ultimately when you're trading, you're probably going to end up using one strategy. In other words, one strategy that combines the 3, which is what the M21 is going to be. But as far as doing those together, then that's what I would do. And the same thing with a ROCK position. If I do my ROCK position the same strikes as my Bearish Butterfly, because if you start your Bearish Butterfly 56 out, if you start a ROCK 30 days out and the price has moved, then I might start with an 1100 Bearish Butterfly, and when I do my ROCK trade, I choose to purposely put it at a strike that's going to coincide with my Bearish Butterfly, so that if you notice the whole system's together, everything is spaced 20 points apart, and it allows you to deal with keeping the positions all at the same strikes. If you start doing in the middle, then yeah, you start canceling everything out. But you can manage everything in the same strikes. Hopefully that makes sense. If it doesn't, I can do an example maybe next week or something. If you ask me again, just ask me next week to do an example because we're running late. And the last thing is I show an M21 position? Yeah, it's very clean right now, but for February, I'm running. It's not in this account. The thing with an M21 position is that an M21 position is going to be a custom planned trade every single month, and it's going to be custom planned using a combination of the M3 Bearish Butterfly and ROCK concepts, and every month is going to be a little bit different. So this month here, as you know, I'm expecting the market to come down and possibly be in this range. I am expecting actually to break this range and be in here somewhere, February expiration, so 1125. So I plan to trade out that's going to withstand an extended move up if it takes off, and I already have my adjustments picked out for when the market comes down and retests the 1075 level, and then I'm expecting the market to close up in here somewhere. That being the case, then this is what my M21 trade is going to look like. Well, we gotta let this download for the month this month. And it's going to be, let's see, this one here. Right, so this is what the trade looks like for now. So if we close in this area, if we come down, look at our charts, if we come down and test the 1075, then this is going to end up getting rolled back and widen out a little bit. And I'm going to have this planned out. It's kind of hard to explain in a short time. I'd have to show you. But basically this is planned out. So right now, if the market just kind of drifts back, we're looking at like $125,000 profit. But what's probably going to happen here is we're going to come back into here. So I already have my adjustment plans to bring this down to about 1075 and then return and come in with a $75,000 profit for the month. That is what I'm looking to do in this trade. So if things work out, that's what I'm looking for a profit here, is somewhere between, probably 50 and 75 for a month like this. But this is the position I'm in right now. And like I said, I'm going to be aggressive in adjusting this when it comes down into here, aggressive in adjusting this back, and then I'm going to allow my delta to get a little bit positive at 1075, and then I'm going to swing into here and try to close the month out here. If we're wrong and the market continues to go up, then we'll just do what we've been doing with this thing most of the year if we've been wrong, and that's just continuing to widen it out. But that's pretty much what that is. No, I don't think I need a long call because I don't think the market is running is going to be up here. That goes against my opinion of where the market's going. So. And like I said, this is a custom designed plan for every month. Sometimes we do have a long call on these. Sometimes I don't. But in general, that's a nutshell of what the plan's going to be and what I'm expecting to get out of this. So that is pretty much what we have there. All right. So I think that's it. I think we're all set. We've answered all our questions. Thank you for attending, everybody, and best of luck trading this week, and we'll talk next week. Okay, have a great day, everyone.